Your assets do not rise because you became smarter. Your assets rise because the rules of the game changed while you were busy pretending nothing fundamental was happening. And here is the part nobody wants to say out loud. In the United States and across the Western world, your financial future is increasingly tied to politics, power, and asset ownership strategies you will never see in a retirement brochure. In 2026, that is not an opinion. It is a mechanism. This is financial education, not financial advice. I am going to walk you through how modern wealth is being manufactured, how it is being protected, and how the same playbook keeps showing up in different costumes. Corporate logic disguised as government policy, credit disguised as opportunity, and stability disguised as certainty. Right now in 2026, you are not just dealing with inflation. You are dealing with the aftershocks of inflation. You are dealing with wages that did not catch up. You are dealing with interest rates that move the entire floor of cost of living, not just borrowing costs. And you are dealing with something else that is harder to measure but impossible to ignore. Artificial intelligence is cutting middle-class work faster than anyone with a suit and a press conference can admit. So when people tell you to learn to code, or start a side hustle, or invest for the long term, they are selling you comfort. Comfort is not a plan. Comfort is what you buy when the plan is already decided by someone else. Now, the original claim you heard was basically this: a businessman like Donald Trump would run America like a corporation, prioritize assets, reduce what he calls bad debt, and then use global bargaining power to push money and leverage toward the United States. Whether you like him or hate him, that corporate framing matters because markets respond to certainty, and certainty often comes from policy. In 2026, you should think about the economy the way a banker thinks about risk. Risk is not will inflation go up or down. Risk is who holds the assets, who controls the cash flows, who gets protected when things break, and who pays when the bill arrives. And here is where the story gets truly ugly. The mechanism is older than any election cycle. It is just getting more explicit now because the global financial system is under stress, and the winners are tired of waiting. Let me start with your everyday life, because it is the easiest way to see how the system is behaving. Picture a 34-year-old nurse named David. He lives in the kind of suburb where the billboards always say community, prosperity, and jobs. He works overtime. He does everything right, which means he saves in a retirement account, he avoids credit card debt, and he watches interest rates like it is sports. In 2019, David could look at his paycheck and believe the math. Rent was high, but it felt survivable. Groceries were annoying, but not a constant punch in the throat. Then the world broke. Inflation ate purchasing power. His employer adjusted wages slower than prices. Then the central bank raised rates to fight inflation, which sounded responsible on TV and felt cruel on your mortgage statement. Now in 2026, David's salary buys less than it did in 2019. He does not say it like that because people do not talk like this at dinner parties, but you can see it in the details. A small increase in insurance premiums becomes a monthly crisis. A temporary reduction in hours becomes a permanent change in lifestyle. His retirement fund may be higher on paper, while his lived experience shrank. That is the opening act. The darker act is that while your purchasing power fell, asset prices and asset ownership concentrated upward. The stock market can rally while your household balance sheet erodes. That disconnect is not an accident. It is a feature of how modern capitalism monetizes fear and scarcity. In 2026, the top 1% owns more than ever, not because the economy got magically better for them, but because the system is designed to reward capital and protect capital when policy tightens. If you have assets, interest rates can raise the price of your collateral or increase your income through dividends and yield. If you do not, rates raise your costs and reduce your options. Now connect that to AI. AI did not only disrupt jobs, it disrupted bargaining power. When companies can automate parts of tasks, they do not need to raise wages to keep labor. The result is a labor market that still looks employed in headline numbers, while real workers feel trapped. You can have a job and still get poorer relative to the cost of living. And that is the trap. You can be busy, employed, and still losing. So you keep watching the wrong scoreboard. This is why political shifts matter more than you were taught. Not because politicians are magic, but because they control credit conditions, taxes, regulation, and international bargaining. Those levers decide whether the United States behaves like a debtor nation begging for capital or like a creditor nation harvesting assets. Let's move into the first big idea. Run America like a corporation, optimize income, cut spending, and treat global security as a pricing negotiation. In corporate terms, the government has two major income streams: revenue from taxes and other collections, and the ability to borrow. It also has major expense streams, defense, healthcare entitlements, interest on debt, and everything else that keeps the machine running. If you are running a company and your expenses exceed your revenue, you do not simply hope, you cut costs, raise prices, and refinance risk. The problem is that a government cannot cut some costs quickly without causing social backlash. So the playbook often becomes shift costs to someone else, raise what you can raise, and reduce what you can reduce without triggering immediate collapse. In the United States, defense spending has been used as a political instrument for decades. The basic story you hear is, we protect the world. The corporate story is different. We station troops and we incur costs, but we can demand that allies pay more, do more, or accept a smaller footprint. It is not morality, it is cash flow. In 2026, this matters because the world is already stressed. Global debt is beyond $300 trillion. You can feel it in every bond market headline. You can see it in corporate layoffs disguised as restructuring. You can even taste it in the insurance market, where climate-driven losses have forced premiums upward in areas that used to be affordable. So if the United States wants to keep borrowing while paying less out to allies, the easiest lever is bargaining. Tariffs, sanctions, and defense cost sharing. You can frame it as strategy. But the underlying goal is predictable. Improve the fiscal balance, reduce external expenditures, and strengthen the trust that the United States will remain an attractive place to park capital. Now imagine the United States as a holding company. Holding companies do not only chase profit, they chase balance sheet strength. When you have a strong balance sheet, you can borrow cheaply, and when you borrow cheaply, you can keep acquiring assets at advantageous prices. That is not fantasy. That is how markets work. In 2026, you might be thinking, okay, but what about ordinary people? Ordinary people are not the target of these strategies. Ordinary people are the labor pool. Ordinary people are the voters. Ordinary people are the customers of financial products. But when policy decisions change cash flows, asset owners are the ones who feel it first. Now here is a pattern interrupt. Stop thinking of politics as emotional theater. Think of it as cash flow engineering. When policy threatens the stability of long-term borrowing costs, bondholders react. When bondholders react, the price of your job security and your mortgage options can change. When your mortgage costs change, your ability to build wealth changes. When your ability to build wealth changes, the ownership gap widens. And once that ownership gap widens, the future becomes self-reinforcing. AI automates work. Automation reduces wage leverage. Housing costs lock people into renting longer. Retirement becomes later and less secure. And wealth concentration keeps accelerating. So yes, the first big idea is about costs and income. But it is also about trust. You can borrow more if lenders trust you. You can raise taxes more easily if the economy does not revolt. You can pressure allies if your currency and your markets remain credible. Now we step to the second idea. Use tariffs and global bargaining to shift wealth toward the United States. Tariffs sound like trade politics. But for markets, tariffs can operate like forced reallocation. They can change who captures profit margins in supply chains. They can influence where factories build. They can influence currency flows. And they can become a tool to tax foreign producers so domestic firms gain relative advantage. In 2026, tariffs matter because the global supply chain is not just expensive, it is fragile. Climate-driven disruptions have increased shipping uncertainty. Insurance premiums and risk assessments change shipping routes and costs. Port operations have become another source of friction. Governments are also competing for industrial capacity because AI and defense both need chips, software talent, and reliable infrastructure. So when a country pushes tariffs, it may also be pushing for strategic industries to consolidate at home. That can create domestic employment, yes, but it can also increase prices for consumers. And if wage growth does not match price growth, ordinary people take the hit while policy claims strategic gains. Now connect that to your household. If tariffs raise the cost of goods you consume, your purchasing power drops. But if policy simultaneously pressures interest rates, your borrowing cost can still stay high relative to your income. So you get squeezed from both sides. Meanwhile, firms that benefit from tariff protection or supply chain relocation can earn more. Those earnings flow to investors. Those investors often already own a lot, so the benefits stack upward. And here is the cruel joke. You are told to invest diversified, but diversification for an asset owner can mean owning more of the very winners created by policy. For you, diversification often means a handful of funds that track broad indices, which still rise during policy-driven booms even as your life becomes more expensive. In other words, the stock market can keep climbing while you struggle to make ends meet. That disconnect is why people feel angry and confused. They are not stupid, they are experiencing an economic reality that financial media often hides behind charts. Now, the third idea is the part that turns this from economic analysis into something darker. Treat foreign nations as asset pools and negotiate for asset control, not just trade. You may have heard claims about annexation and purchase of territories. Put the politics aside for a second and focus on the financial logic. The logic is, if you cannot print enough certainty from promises, then you acquire certainty from assets. In corporate practice, if you need long-term value, you buy assets that generate cash flows or can be monetized later. If you have undervalued resources, you can wait for them to become extractable or profitable. If you have resources locked behind regulatory barriers, you can negotiate control or purchase access. That is what investors do when they look for optionality. They do not only buy what is productive today, they buy what could become productive when constraints loosen. Now let's translate the concept into a world you actually live in. In 2026, climate change is unlocking new strategic value in places that were once inaccessible or uneconomical. Insurance pricing is reshaping geography. Migration patterns are reshaping political bargaining. Energy infrastructure is getting rebuilt with new risk assumptions. Resources can become more valuable because the world's cost structure changes. Energy, minerals, shipping routes, ports, and energy refining capacity can move from infrastructure to strategic ownership overnight. So when someone frames policy as asset acquisition, it is not just nationalism, it can be a bet that long-duration value will become liquid later. But here is the cliffhanger you need to sit with. Asset acquisition strategies do not help everyone equally. They require capital, and they create concentration. They often reduce transparency about who pays and who benefits, and when global borrowing stress rises, asset control becomes a way to avoid relying on lenders you do not control. Now, pattern interrupt number 2. Ask yourself a question at 2 a.m. If a country is trying to secure long-term repayment credibility, why would it do the slow, painful work of reforming domestic spending and taxes before it secures external assets? The likely answer is, because external assets can be used as collateral in the market's imagination. Markets love collateral narratives. They do not love human suffering. They love balance sheets. This is where the housing crisis connects. Housing is domestic collateral. It is the asset your household depends on. When housing becomes unaffordable, your ability to build equity collapses. When equity collapses, you have less collateral value. Less collateral value reduces the feel-good story of wealth building. So if housing becomes unstable and workers struggle, the state may try to stabilize the system by shifting risk away from banks and toward policy frameworks that keep asset prices elevated. Which brings us to the fourth idea, and it is the ugliest. Privatization and credit guarantees in housing finance can determine whether ordinary people get protected or discarded. In the United States, the housing finance system relies on government-sponsored entities that historically were designed to support mortgage liquidity. In simple terms, when credit is tight, these structures can keep money flowing into mortgages. When they do not, lending standards can tighten suddenly, and fewer people qualify. The original transcript framed it with a specific fear. If major housing-related entities are fully privatized, the implied government backstop disappears. If the backstop disappears, then lenders may demand higher down payments, lower loan-to-value ratios, stricter underwriting, and higher interest rates to compensate for perceived risk. Now you might say, that is just financial policy. But it becomes brutal when you consider what happened already. In 2026, many people are not just facing higher mortgage rates relative to their incomes, they are facing a housing market that has detached from wage growth. For years, home prices rose faster than salaries, and then rates spiked, and then affordability got worse. Even if inflation cools, the housing floor does not reset quickly. And that means one thing: people either become long-term renters, or they buy at the top of a credit cycle with monthly payments that stress them until they break. So if credit standards tighten further because guarantees shrink, the result is predictable. Demand falls. Forced selling increases among those who already stretch their budgets. Prices can wobble. And when prices wobble, it hits the people who are leveraged first. Now, pattern interrupt number 3. Remember what you learned in 2008, or remember the feeling of it, even if you were not alive or not old enough to understand it. In 2008, people did not just lose houses because they were greedy. They lost houses because the credit machine changed, and the promised stability was not stability at all. It was stability backed by policy decisions that could reverse. Now imagine a system where the promised stability might reverse again. That is what markets price when they anticipate policy changes and guarantees. It is not a conspiracy. It is how risk is priced. And if risk is priced into mortgages, then bond markets respond too. The yield curve can shift. The cost of borrowing can change across sectors. That affects corporate investment. That affects employment. That affects wages. It is a chain reaction, and ordinary people are always at the end of the chain. But the wealthy are not helpless. Wealthy investors can hedge, diversify, use leverage strategically, and buy assets when others must sell. This is why the stock market often diverges from everyday hardship. During stress, some investors can buy risk at a discount. If the policy response includes liquidity expansion, asset prices can recover before your life does. You may see a booming index and still feel poorer. Now, the transcript also implied a deeper logic. If the United States wants to avoid being forced into money printing that spooks lenders, it might instead aim to expand assets through external control or through mechanisms that reassure markets it can service debt. This is the part where you need to understand the psychology of the bond market. When central banks print money or signal easier policy, markets can interpret it as either support or dilution. If investors believe dilution will erode the currency, they may demand higher yields to compensate. But if investors believe that external assets, strategic industries, and geopolitical bargaining will provide repayment credibility, then they may tolerate more government issuance. That is how trust becomes a financial instrument. Now connect that to the Federal Reserve in 2026. The Fed sets the price of money, but it does not control all economic outcomes. In the real world, the interest rate decision impacts mortgage rates, credit card rates, auto loans, and business borrowing. It impacts the affordability of everything that requires debt. When the Fed raised rates to fight inflation, it cooled demand, reduced borrowing, and made life harder. But the inflation is down narrative does not magically restore purchasing power. It just means the rate of damage slowed. People feel the lag. They feel it in grocery bills, rent renewals, insurance renewals, and the cost of repairing their car. They also feel it in the way AI is changing employment opportunities. When rates are high, companies cut costs more aggressively. When costs are cut, jobs shrink or shift. So your fear in 2026 is not one fear. It is a pileup, inflation damage, AI disruption, housing instability, and a retirement system that is underfunded in many places. Social Security, in simple terms, is delayed by policy decisions and constrained by demographics. Pensions can be underfunded. The aging population increases cost pressure. That means future obligations get more expensive. Now zoom out. Global debt is above $300 trillion. That is not a number. That is a political constraint. It means someone somewhere will be forced to pay. When it is time to pay, the least protected people get hit first. So, when a policy team says optimize assets and reduce bad debt, what does that mean in practice? It can mean shifting risk away from institutions that control capital. It can mean keeping funding channels open. It can mean tightening belts for some groups